And the sell-off lasted not very long at all. Stock markets apparently finding their feet again today, but ultimately failing to go anywhere once more. The slow grind that we've been watching for the better part of a week and a half, almost 2 weeks now in the S&P 500 and almost 6 weeks in the NASDAQ continues. We get a nudge and then a bounce and then a nudge and then a bounce. And we seem to be struggling to get anywhere with any kind of consistency, whether it be up or down. So what is going to move these markets from here? That's what we're going to explore here. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And what we're going to do here is take a look at what it is that got us here, what the markets seem to be struggling with, why they can't seem to make up their mind one way or another on direction, and then look at what might be a set of catalysts over the course of tomorrow and early Monday that might at least begin to create a bit of clarity. So let's begin here with a look at the price action itself. And we'll just kind of take a moment here and digest. Here we are at the beginning of March. And here we are now. We've gone next to nowhere. Here's the Fed policy announcement where we pointedly got that very enthusiastic rise around the idea that the Fed is going to cut 3 times, whereas the markets thought that hot economic data was going to maybe push them to 2. That found no follow through, and in fact, we kind of just cracked lower back to where we were. Look at the past several days. Last Wednesday, we try to make a break through this range bottom. Then we get a good NFP number and come back. Note, though, if this was the bottom of the range, we did not overtake it. And when we then struggled to make any kind of headway up or down, waiting for the CPI number, and that CPI number came in hot and dumped us back down, we again stopped at the bottom of the range. What do we see today? Again, just like here, a rebound that doesn't overtake the previous levels of support. So we nominally seem to be making lower lows. We nominally seem to be making lower highs, but we're not really getting anywhere. It's a similar story for the NASDAQ. Here, things are even more choppy. We basically haven't gone anywhere since the middle of February. We sort of nudged up here toward the end of the month, and then all of the month of March, we just ground sideways. Here's that Fed announcement. Again, not even a single day of follow through, a slow rollover. Last week on Wednesday, the sharp decline, the bounce that doesn't overtake the former point where the break occurred, slow, CPI, and at the very least today, we overtook the CPI move. At least that much is there. But again, sideways, flatline. We haven't gone anywhere for the better part of 6 weeks. So what is it that the markets are thinking here? Where's the directional conviction? Are we going to sell off? Are we going to rally again? Markets seem unsure. Just for context, here's the CPI number that got everybody so hot and bothered. I would argue the biggest issue here was that the core number, which was expected to come down from 3.8 to 3.7%, didn't and registered unchanged. The increase in headline was a little bit larger than expected, but it was seen going up from 3.2 to 3.4. It went up to 3.5, arguably because of a greater rethink as far as the implications for crude oil and otherwise the energy sector's kind of rebasing. We can see here that it was a meaningful source of deflationary force here late last year and into this year. And we can see that it's in that period diminishing. And just where CPI was on a very clear escalator down, then stopped and started to move sideways, this also is where the negative influence from oil essentially peaked out and started to rebase down. And so CPI has been stuck. But the Fed can't do much about that. What they were focused on was this core thing, which mainly follows what's going on with the inflation still locked in the service sector. I mean, very clearly, you can see that's the overwhelmingly important contributor here. Goods inflation, even excluding food and energy, is actually a pittance. It's almost non-existent. In fact, slightly negative. So the price of stuff at the store is actually down from a year ago. The price of energy is actually down from a year ago. It's really the service sector where the prices are stuck higher. And of course, the markets looked at this and said, well, this means fewer Fed rate cuts. And the readjustment was really quite dramatic. We were sitting at about 57 basis points in Fed rate cuts before the Fed ostensibly got their lead from this CPI data, and that was already on the hawkish side of their own forecasts. So we can see here the Fed projected in December and reaffirmed in March that they're looking for 75 basis points, give or take, in easing this year. That's this line down the middle. And as I've argued, the markets want future money to be cheaper as a key catalyst for the markets, as a key driver for risk appetite. Because with all the various boogeymen circling around in the world at the moment, be it the wars in Eastern Europe or in the Middle East, be it lingering concerns about what the cumulative effects of aggressive rate hikes in a hurry will do to the economy, be it the anemic recovery in China, there's no shortage of reasons to be concerned. But these are hypotheticals. Nothing has actually come undone. The U.S. economy is doing reasonably well, as we'll just see in a moment. And so what we find is that risk appetite seemed to want the promise of future money being cheaper to essentially say, yeah, there's all these risks, but what's the worst that can happen? We lose some money and we borrow it back cheaper and go again? Let's take risks. And so when you see that late October, early November, the outlook for Fed rate cuts starts to build out because the Fed is saying we're done hiking without really establishing a baseline for what that means, the markets obviously run away with their most optimistic idea and bake out anywhere between 5 or 6 rate cuts, depending on which future spread you look at. But looking at the current contract, it's all the way out to 5 cuts, 6 cuts here. And so as that happens, not surprisingly, stocks go up. You can see that once they anchor here into the calendar year turn, stocks stop, waiting to see what next steps are. As the calendar rolls over to the beginning of this year, the spread is still for much cheaper money than what the Fed benchmark is. And while that remains the case, stocks keep marching higher. We'll note what happens when it durably gets to the other side of the Fed's line. Stocks stop and are now wondering, well, okay, so now future money is going to be more expensive than the Fed has benchmarked it. Now I'm concerned. Now I don't want to take risks. Perhaps. Because now, if I lose, I have to borrow back more expensive money. Now there's an issue. Risk appetite seems to have been sapped. At the same time, though, as we've just said, things aren't falling away either. And that is perhaps because the reason we've had this adjustment is not a bad one. When you look at the way that U.S. economic data has performed relative to forecasts, we can see that since the beginning of the year, it has increasingly improved. Now, that is not to say that the U.S. economy is per se accelerating. What it is saying is that the U.S. economy is doing better than economists expected. And by the way, note, all through the second half of last year, the economy is doing worse than expected, at least relatively speaking. Obviously, this index being north of zero means that economic data out of the U.S. is tending to beat forecasts. But you can see the margin by which it does so is steadily decreasing all through the second half of last year. And of course, shock of shocks, what do we see through that same period? Policy expectations normalize after the banking crisis and the then episode of the debt ceiling circus. And then they build out to more cuts. But this year, the economy seems to be reaccelerating, at least relative to forecasts. It isn't reaccelerating in absolute terms. In fact, if we look at the PMIs here, it seems like basically since the beginning of the 2023 calendar year, we saw a little bit of a pop in services. Manufacturing remained anemic, as ever. This is in the logic of PMIs here. So this is centered around 50, where that's neutral. And above 50 is growth. Below 50 is contraction. The further you go above, the faster the growth. The further you go below, the faster the contraction. And what you find here is that from early 2023, basically into the middle of the year, give or take, services lift the economy up. Manufacturing is anemic. As you get into the second half of last year, services obviously cools off, you can see here, and pulls the overall economy down with it. Services is of course, the dominant economic sector for major economies, and the U.S. is no exception. And then you kind of get this flat line. Manufacturing ultimately catches up. You can see its return to growth. It's come out of contraction territory, but all these numbers are within a hair of each other. Basically, since the beginning of the year, the economy is on autopilot. It isn't falling off, but it isn't accelerating. Whereas it looks like expectations were looking for it not only to just stand, but to decelerate. And so expectations have been overcome here. And because of that, there's been fewer cuts that are baked in. So it's not as though these cuts are going away and this inflation is sticky for necessarily bad reasons. And so the markets are left wondering, well, if the economy is doing fine, maybe it can just withstand the higher rates. Maybe there need not be a problem here. Maybe we're thinking about this in terms of our risk appetite vis-a-vis rolling the dice on investments and wanting to get cheaper capital in the future as a cushion to risk-taking now. But maybe for the economy, this is actually not bad news. And what this speaks to is eventual earnings expansion and a kind of re-anchoring for the next leg up in assets, because the economy is reaccelerating, or at least is holding its ground despite the various risks, and doing head and shoulders better than other developed economies, by a long, long mile better, as a matter of fact, than the rest of the G10, to say nothing of the morass that's going on in China. And so if we look at all of this, maybe we're wrong to be worried. And so as markets weigh these things, markets are locked in place. S&P is not going anywhere. NASDAQ's not going anywhere. It seems like the markets are kind of perplexed by the idea of, we don't like higher rates, but maybe the economy can weather them, so maybe this is not an issue. And in figuring out what this might look like and where the pendulum might ultimately swing, the next question might very well be, well, what do the consumers have to say? Because where they go, so too the economy evolves. Because in the US, as it is in most developed economies, household consumption is anywhere between 75 to 80% of GDP growth. It is all about the consumer. Well, helpfully, we're going to get some data to inform our view. On Friday this week, that is tomorrow, we are going to get updated numbers on U.S. consumer confidence from the University of Michigan. It is expected to show things are holding steady at relatively high levels. You can see for the sentiment index, which is a composite of current conditions and expectations going about 6 months forward, we're basically anchored. But we're anchored at some pretty heady levels. These are 3-year highs that we're sitting at here. And the expectation is that we're going to basically sit at these highs here again in the April survey. And what you find is, really going back to the middle of 2022, the driver of this recovery has been a successful Federal Reserve fight against inflation. Because you can see 1-year inflation expectations, as polled from consumers, have fallen. It's been choppy, but they've fallen and fallen and fallen, and are now at a relatively reasonable level. And the expectation is that they're going to come in from 2.9 to 2.8% in this survey. The risk, of course, being that if the recent pop in gas prices is going to show up in this survey, then we might very well see a pop in inflation expectations, a drawdown in consumer sentiment to follow. Although, in fairness, these things don't always happen in perfect sync. We can see here, for example, that rising inflation gets immediate response from consumer sentiment. We see the same thing here. As this starts to pop, so too consumer sentiment comes in. But at the big reversal point, it takes months. The inflation outlook is peaking and hits its critical levels a good quarter before sentiment bottoms. So it doesn't have to line up exactly, but if these inflation expectations spike and consumer sentiment comes undone, well, then the markets will have their answer. Because that would mean that the Fed has to do meaningfully more. It has to change its tune. It would not then just be, oh, we can look through this near-term pop in inflation. Then you have to do something, because if you don't, inflation expectations get anchored and they can become devilishly difficult to fight from there. Then on Monday, we're going to get U.S. retail sales data. No big action here in the month-on-month numbers. They're expected to come in with growth of 0.3%. That would be basically within the recent range, give or take, down from 0.6% in the prior month, but certainly not catastrophically so. And you can see this series can be a bit volatile around 0. But the real question is going to be for the year-on-year numbers, which, as you can see here, have taken a meaningful step lower. at the beginning of this year. Now, of course, there's been a steady cool off since COVID. And then since the middle, let's call it, of last year, retail sales have cautiously reaccelerated. And now coming into this year, we have the opposite. They've cooled significantly. As a matter of fact, if we look at the average year-on-year rate for retail sales in 2023, 3.4%. The average for the first 2 months of this year, 0.8%. So clearly the pace of retail sales growth has meaningfully slowed, albeit it's only been 2 months. So we'll see. But as we look at this, what we find is a story about just how healthy this business cycle is. Is it going to be able to withstand rates significantly higher with only perhaps one cut on the menu this year and some optionality for a second? And if it can, if retail spending can hold up, well, then the economy is probably okay, at least for now. It is weathering interest rate changes, at least for now. And there's no reason to panic, at least for now. However, if we start to get inflation expectations in the survey up, if we start to get consumer confidence weaker, if that gives us softer retail sales numbers as a result, well, then we might be looking at the kind of thing that first threatens the business cycle, and second, threatens the Fed's ability to get to its mandated target on inflation. And so on the one hand, you might be worried about earnings. On the other hand, you might be worried that the Fed is going to have to get a little bit more aggressive. And if that's the case, well, then sentiment might really crack and risk appetite might evaporate in earnest. So we could be looking at defining data here as the markets attempt to pull themselves back from hanging on every word of Fed officials and go, okay, but what's going on with the actual business cycle against this backdrop? And that is defined by the consumer. So perhaps a moment of make or break decision making is almost upon us between tomorrow and the start of next week. And that is macro money for today. As ever, we are here Monday through Thursday every week, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what it might mean for what happens next. I'm back on with Chris tomorrow for Futures Power Hour, as I am every Friday. I'm on with Tom and Victor for First Call on Sundays. I am also writing for the News and Insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back next week, and I'll see you for Futures Power Hour tomorrow. Happy trading.